So we're looking for quite a transition in currencies in Q3 and market themes more broadly, away from what I've been calling the Goldilocks trade, where the less hawkish than anticipated Fed and the very easy ECB and BOJ policies have really continued to drive global liquidity and easing financial conditions into a bit more of a rougher environment. And there are two drivers for this. The first of which could be a more hawkish Fed as if the U.S. economy mean reverts a bit and improves a little bit, but even if it doesn't, the Fed will not be hawkish for a very negative reason, and that would be a weakening U.S. economy. At the same time, the chief crackdown on global liquidity is coming via China, where we've been talking about this credit impulse for quite some time. China trying to get its financial house together to a degree not seen in quite some time after a very large expansion in credit in 2015 and into early 2016. And this credit impulse is going to transmit to the rest of the world with a lag that will start being felt in the second half of this year. So what will this mean for the major currencies? Well, tighter liquidity tends to see dollar safe haven trading. Depends on the degree to which we see risk aversion. That's one of the big uncertainties here. But in general, we would expect the dollar weakening to slow, and we could even see some dollar firmness. By the same token, euro we think could top out at some point during the quarter towards 115 against the dollar, possibly a little bit higher if this sort of summer drags out with a low volatility environment and we don't see this theme picking up until later in the quarter. The Japanese yen could be a real wild card depending on the degree to which tighter liquidity means higher rates and to what degree it means risk aversion. So I think it's going to be a bumpy ride for the Japanese yen, but it is getting towards the weak end of its potential. So the currencies we think most at risk in this environment are going to be those that are most highly impacted by tightening credit spreads, whether for emerging markets or corporates, and that tends to mean somewhere out on the risk spectrum. And across the risk spectrum, we have everything from commodity-linked currencies in developed markets, the Australian and New Zealand dollars in particular, but also the Canadian dollar to a degree, and then of course the emerging market currencies, which will be the most impacted by this and the highest beta, if you will, to this theme. These emerging market currencies have been on a tremendous run since early 2016 when these fears of a much more hawkish Fed sort of faded. The Fed has tightened policy, but let's recall to a far less degree than was anticipated at the time. So either we get the Fed picking up again, which is emerging market bearish, or it's because, if they don't, it's because the U.S. economy is doing more poorly, which could also be bearish for credit spreads from that angle. So I think it's a lose-lose potential. There is some risk that over the summer we see very, very low volatility if nothing crops up, but I think we do see this theme emerging in Q3. One final note, I think something that is unprecedented going into this quarter is the geopolitical backdrop here, which could lead to all manner of mayhem or not, depending on how things develop, whether it's in the Middle East, whether it's a confrontation between U.S. and Russia there or elsewhere, and of course North Korea. So I think a strong caveat across the board there from geopolitical developments, where it feels like the market is ignoring these to the greatest degree I've witnessed in my career.